Lesson 6. How to set Forex trading objectives that keep your risk small and let you win big. Welcome to Lesson 6. My name is Sam Eder. I'm a global macro currency trader and the owner of FXRenew.com. This is the advanced Forex course for smart traders. Ray Dalio said, you have to start with your goal. It's far too easy to take this Forex thing casually. You can open an account with a broker in the blink of an eyelid, and in 2 more blinks you can be trading Forex. But Forex is a game of skill, played by some of the most sophisticated, well-connected and intelligent men and women in the world. Every time you trade, it's like playing chess against a chess master. So do not think that having sloppy objectives for what you are trying to achieve is going to cut it. The good thing is that once you do understand how to craft proper objectives, a number of nice things happen. You stop losing money, even if you don't always make it. You trade with purpose. Your discipline goes up several notches. And you really start to capitalize on big moves. From foundation to system development. The first lessons in this course have been foundational in nature. We now move to a more tactical level, where you will develop a simple, robust and insightful trading system that will eventually meet your financial goals. And this starts with setting objectives for your system. Every good trading system has clear and well-defined objectives. The main objectives you will need for your system are returns, maximum drawdown, chance of a maximum drawdown, trading opportunity, win rate, targeted risk-reward ratio, maximum number of positions. Once you have clarity on these objectives, you will have the ingredients you need to build a powerful and robust position sizing model and to construct a set of trading rules to achieve these objectives. Constructing a return objective. Saying, I want to make lots of money is not a good objective. Instead, you want to be very specific about how much you want to make and over what time period. For example, I want to return 10% on my capital over a month. If you're not specific in your objectives, you'll make mistakes when you trade. In particular, you'll cut winning trades short as you are not clear on what you need to achieve from the trade. How to decide what is right for you? You have several considerations. How much capital you are allocating to Forex trading, how much time you have for trading, if you are a day, swing or position trader, the size of the drawdown you are willing to accept, the number of different systems you will be running, your individual psychology, your confidence level. Ultimately, it will be a personal choice specific to your goals. Your objectives could be based on your financial freedom goals from Lesson 3. In particular, it is useful to know your financial freedom number so you can work back towards your profit objective. For example, if your financial freedom number is $5,000 a month, then your objective for your trading system could be to make $5,000 a month. If you have $50,000 to trade with, then that would mean your profit objective would be to make 10% return a month. Future money managers, objectives are critical for you. For those of you that are one day looking to manage money, objectives are of particular significance. You need to understand what objectives you'll be assessed against and then build a system that fits. Here is what a friend of mine who is a hedge fund head trader has to say on the topic. Gain an understanding of the metrics that you need to achieve, ideally before embarking on creating the track record. Then devise risk management and a trading strategy that achieves those metrics. Starting out in Forex? Not all of you are going to want to start with the full amount of capital that you will eventually trade with. That is, of course, okay. Start with an amount that you are comfortable with. What is critical is that you trade it like a smaller version of your targeted account. Don't use a smaller size as an excuse to take a punt or you will develop bad habits. Market wizard Steve Clark said, your job as a trader is to protect the direction of the equity line. Balancing the equation with a maximum drawdown objective. In order to make money, you need to risk money, but the good thing is that you are in control of what you risk. A drawdown is the amount of loss you are willing to sustain in order to go for your profit objective. For example, if you had a trading account with $10,000 in it and you lost $1,000, then you would be experiencing a 10% drawdown. While you might never want to have a drawdown, they cannot be avoided altogether, and they should be simply seen as a cost of doing business. This means you should plan for them prior to their occurrence. How big a drawdown should you allow? Drawdowns can be tough. To make it easy on your trading psychology, you want them to be as small as possible, but typically the bigger the drawdown you are willing to accept, the greater your returns will be. To use an example from history, the famous turtles, who were trained by market wizards William Eckhart and Richard Dennis, had a combined return of close to 25% per year. But at the same time, they had to suffer through a drawdown of 35% at one point and multiple smaller drawdowns. In general, you will want to make your maximum drawdown no greater than 50% of your return objective. For example, if you have a return objective of 10% a month, your maximum risk should be no more than 5% a month. I would suggest that you be even more conservative with your drawdowns and risk no more than 2 to 3% a month if you are looking to make 10%, or 10% a year if you are looking to make 50%. Recovering from a drawdown. It's important to note that once you go past a 25% drawdown, it can be difficult to recover. Check the table in the written version of this lesson for more information. Percent chance of the drawdown objective. Once you establish a maximum drawdown objective, you want to consider how comfortable you would be experiencing the drawdown. This will greatly affect your position sizing model. For example, if you have decided that your maximum drawdown is 10% and you are willing to risk a 100% chance of this happening in order to achieve your goals, then you would trade very differently than if you only wanted a 5% chance of ever experiencing your maximum drawdown. What to do when you have a drawdown? If you experience a drawdown, you have a few options. These include reducing your position size, keep trading the same size and wait for the winning trades, pause your trading and review what's working and what's not, stop trading altogether. You should have it written in your trading plan exactly what to do. Trading opportunity. How often you trade will significantly impact your position sizing and trading strategy. If you place 100 trades a month, you will need a different structure than if you place 20 trades a month. More is not always better. Many traders tend to overtrade and their returns suffer because of costs and mistakes, such as the failure to hold on to big winners. You can choose how many trades you get right. It might come as a surprise, but as a trader you get to choose how many trades you get right versus how many you get wrong. This is your win rate. It's important to note that the higher your targeted win rate, the lower your profit per trade is typically going to be. Market wizard Van Tharp said, "Knowing when you're going to exit a trade is the only way to determine how much you're really risking in any given trade or investment. If you don't know when you're getting out, then in effect, you're risking 100% of your money." Risk-reward objectives. Once you have chosen your win rate percentage, you want to attach a targeted risk-reward ratio to your win rate. For example, if you have a targeted win rate of 50%, then you might decide you want a 3-to-1 profit ratio. This means that you want your winners to make 3 times your risk on average. Maximum number of positions. In Forex trading, you have plenty of leverage available on your account. So it is very easy for the inexperienced player to take on more trades than they or the risk management model can handle. In your trading plan, specify a maximum number of positions that you want to have open at any one time. How many is too many? It really depends on your trading style and position sizing model. Integrating multiple trading systems. You may find that you want to run multiple trading systems at one time. If you do, then you want to set specific objectives for each system and overall objectives for the combined systems. Market wizard Mark Minervini said, "Defining your style and objectives makes it much easier to stick to your strategy." There is no success without action. Setting objectives is an art, and they are personal choices about what you want to achieve. You will likely need to spend some time with this lesson, as it's important that you get very clear on what you are trying to achieve. Start by defining the following 4 objectives: profit objective, maximum drawdown objective, percent chance of a maximum drawdown, and number of trades objective. In the next lesson, we will take a deeper look at how you can use position sizing to achieve these objectives. For this week's coursework, fill out the My Systems Objectives worksheet. I'll see you in the next lesson.